Okay, so now in introduction, we have what are unlisted pre-IPO shares. So essentially, but just that they don't have an active price ticker, which is the price is going up and down when the markets are open. The price is essentially what you bought it at, and you can see it lying in your demat account as a holding. So it is an asset holding. It is traded in the secondary off market, as they call it, which is not on the market but off the market by existing investors. So say I am an existing investor of Oyo, for example, and I hold 10,000 shares of Oyo. I can sell it to somebody else through an off-market transactions, which happens through your depository participant, which is CDSL or an SDL. For those of you here who are at least somewhat aligned with, or are in the know of how markets work, you would have heard, these names would ring a bell. For those of you who don't, CDSL and SDL are essentially just depository participants, the only two that exist in India for the most part. And these depositories allow you to hold your securities and or assets, which are essentially shares. They're held in that. It's for your security, so that these can't get hacked and can't get stolen, etc. So yeah, I think that would kind of simplify that for you. How price growth works is just like listed stocks. Price growth is linked to profitability and demand, which is the demand of these shares, and profitability in terms of how the company is growing, just like any other asset or any other listed share in the market. And finally, the price is defined typically. I mean, that would be an important question, right? That what is it? Okay, yeah, these are unlisted pre-IPO shares, but for a typical listed security, I can see a price ticker on it. How do you define price? That's typically the last fundraise for that company. So let's take the example of True Wealth Club. So we raised a round at 5,000 per share. At that point, 5,000 per share multiplied by the total number of shares is my total company post-money valuation, a pre-money valuation. And that is typically then that gives me a post-money valuation of my company. And finally, the price of this company is then typically the last fundraise plus any premium based on demand or supply. So say anyone is paying me a premium on top when I'm reselling it in the market, because say the shares of TrueWealth.club or True Wealth Technologies are extremely in demand. And so lots of people are like, hey, I want to own this, a part of this stock. And at that point, that premium would drive up the price. And that's what you would pay on top of what is already decided by the last fundraise, which is what the promoters of the company raised their fundraise at. So I hope that's clear. If you do have any questions, like I said, take a pen and a paper if you can. If you like the old school way to do this, it would really help you absorb more of what I'm talking about today. And of course, put down your questions. You can put them in the chat, even though I will take them a little later in the presentation as I go along. Perfect. So who can invest in pre-IPO shares? Essentially, two people, residents or NRIs. If you're a resident in India, all you need to have is a bank account and a demat account. So these two things are absolutely required to be an investor in pre-IPO or unlisted shares. And as an NRI, you need to have an NRO bank or an NRO demat that helps make the transaction happen seamlessly without any external approvals. For NRE accounts, which are expatriable accounts where essentially people hold money that they earn outside in an account called an NRE, for those who are NRIs in the group would know, that account, you're not allowed to transact from that account without taking an RBI approval. And so typically that's not worth the effort. So think about someone's a foreign investor, say I'm Morgan Stanley sitting in Singapore, I would take this RBI approval for doing a very large deal of buying, say, stock worth 100 crore in a company. But typically for a retail plus HNI investor, it would not really be something that would be worth the effort or the time or the money to do it if you only have an NRI. So, but NRE account, but NROs are plausible. So those also make it seamless for NRIs. So residents, NRIs, all you need to have is a bank account in demat. Typically, like a pro tip that I give to investors we work with is think about building your unlisted portfolio across 20% allocation across your total portfolio that you have, because typically this is less volatile. We'll talk more about that in the later part of the presentation, but your portfolio size should be at least 10 lakhs so that you're not really taking this diversification route too early in your journey. So once you at least have a portfolio size of 10 lakhs or and in savings across assets like mutual funds, stocks, like listed stocks, etc., you can be like, okay, hey, maybe I should look at putting 1 to 2 lakhs now in pre-IPO or unlisted securities, because that gives you that potential to drive alpha in your portfolio. So agar aapka basically, you want that slight edge in your portfolio, this can offer you that. All right, why is this market gaining traction? Very important question. So fun fact, first time in the history in 2024, India hosted almost twice as many IPOs than the US. This number was almost 200% up from what India did before in 2023. So 2024, that way a year was incredibly like an inflection point in the journey of IPOs in India. I think Indian companies raised about US $20 billion, while half the number of companies raised about $32 billion in the US. But having said that, the number was up from $6 billion in India in 2023 to $20 billion. So that was like a more than a 3x rise, which is incredible, and just shows that the fact that people are now warming up the idea of investing in companies which earlier they were not doing at the primary market stage itself. So why is this market gaining traction? Growing startup ecosystem. I think everyone mostly typically, I think the group age would be between 30 to 50 here. And of course, you guys know that the startup ecosystem has been doing really well in India over the last 15 years and gaining traction. I think and then no rush to go public. This is a very important aspect about how companies think about raising capital now. As you know, raising capital is essential for a company. I would say very interesting way to think about this is 15 years ago, there was really no way to raise capital in India except to go public. And so at that point, you would have all these companies listing at their face value or slightly higher premiums than their face value, which is 10 rupees, 15 rupees. And you would have these kind of numbers and these kind of companies raising money at that price point. Now, companies come in with significant premiums already because they have had a lot of valuation rounds by raising from HNIs, UHNIs, venture capitalists, private equity players, all of that. So essentially, companies are in no rush to go public until they want to raise very, very large rounds. So Hyundai, for example, as you know, in last year raised a very large public offering, but they really didn't need to do that before, right? Because they had enough capital from their parent and all of those other things. Increasing awareness, diversification, which we just talked about. You have already a stock portfolio, which is in the listed markets. This is typically less volatile from a pricing up and down perspective because it's not actively traded. But of course, we'll again talk more on this later. Early opportunity, you can get in before the larger public does. So I like to say, like in investing, the opportunity lies in lies more in what the others don't know. So if you can get in earlier than other people, you're essentially more likely to do well if you invested in the right company at the right price. And finally, increased risk appetite. More and more investors want to now take on slightly higher risk in their portfolios to give them that higher reward opportunity. And that's why we see this as a clear trend. Finally, what is the opportunity? So this was a nice little stat I liked. I saw it somewhere and I thought I should show it to you guys that, this is the total number of companies that are active today in India. This is the number of public companies, this is the number of private companies, and finally listed is 10% of that, and another 63,000 here, which are unlisted in terms of it. You can actually buy stock in the unlisted market. So of course, these are very, very large numbers, but just shows you the kind of opportunity that does exist in the unlisted space. If you do end up finding the nice companies or you're able to take out the chaff from the tough. Okay, key questions. Now, the next thing I want to talk about which is a very important question, what is really the difference between listed shares and pre-IPO shares? just like four things, simplifying it, opportunity to enter at lower valuation. So that's one key reason or key difference, because once the company is already listed, of course, you can get opportunities to enter at lower valuations as well. But if it's a good company, typically very hard to find it at a valuation that's really attractive, because a lot of the public would already know about this company now and would want a piece of the pie. Zomato, Swiggy, all of these being really good examples of how once they did get listed, of course, there was a downturn in the middle, but largely very hard to get these at valuations that are very attractive. Less volatile pricing, which is the prices don't move up and down every minute of every day like it does in potentially listed shares. Finally, low float, hence low liquidity. What that means is lesser number of investors hold the stock in their demat accounts, and hence obviously there's lower float, or just lower number of shares that are exchanging hands of that coin, and hence the liquidity is lower, which means that you may not find a buyer very easily. Of course, which in listed shares, when you do go to sell a stock, you can just go onto your Zerodha, Grow, whatever app that you use, and you can sell it pretty easily. Finally, exit options. 6 months post IPO listing is when you're locked in till one if you're a holder before. So typically what that means is, let's say you're a large VC investor. So this is actually like a VC investment, right? But think of it as a fractionalized, or I won't really call it that, but small retail level VC investment. So you're buying a small, very, very small share of a company, just how you would do it in a public market scenario, but you're doing it in the unlisted market. And when you do that and you wait for an IPO, you have to wait until 6 months post listing for your shares to unlock for you to sell them. And the other option, obviously, is that you can sell it within the two other investors in the unlisted space. So let's say I have Oyo, like I said, and I would like to sell it to somebody who also would like to own Oyo. I can do that transaction as an off-market transaction, like I called it. And of course, there are platforms like ours, like TrueWealth.club, that enable you to do that seamlessly. So yeah, more on that. Next, benefits of investing in pre-IPO shares. So this is a nice slide because it just tells you a little bit about why you should do this. But you have to obviously look at it from your larger portfolio perspective. But simply, it gives you that potential for higher rewards or alpha in your portfolio, lower market value, volatility, which I've already talked about. The unique investment opportunities is something I want to spend maybe like 10 seconds on more, is that these are typically companies that perhaps have that obviously have not listed already, and in some cases they may not even have listed peers, because say it's an emerging sector, it is something that is coming up. So say let's say a chatbot company which started 6 years ago may not already be listed, and because it's a new space, it won't even have a peer listed in the equity market. So that way you can't take participation in the, if you like the sector and you believe it's going to be huge in the next 5 years, 10 years, whatever. You don't have an opportunity to buy the stock of the company in the listed market, and then the only option is to get it in the unlisted space if that is available. So those are some of the, it does present the unique investment opportunities once every now and then, and that's why again we exist to make that to enable that for our community members and investors in general. But that's essentially a key aspect of why this becomes an interesting space to operate in. Finally, confirmed allocation before your IPO. So as you know, during the IPO, if it's a good company, it's mostly going to be oversubscribed, and it's harder to get a ticket in the lottery or get your allocation in the lottery. And finally, diversification in terms of, just like I said, holding some stock which is not essentially already in your portfolio. And so it gives you a little bit of diversification edge. That's something you're not actively trading, because as humans, we're all an investor. Finally, this investing in pre-IPO shares, very important slide. Also, after the benefits, that you need to understand what are potential risks, and you need to be okay with it. And I would, very important to understand this from, say, our team or anyone else who you're transacting with. There's of course liquidity risk, which is what I talked about, that you can't immediately sell if you need the money, and which is why this is always supposed to be, like I said earlier, shouldn't be more than 10 to 20% of your portfolio, so that it's something which you can liquidate as and when you need it. And of course, if you're holding securities that are very easily liquidable, even in the unlisted space, that's possible. Lock-in or shares post IPO can't sell for 6 months, like I talked about. market risk, pricing and asset risk, which is essentially just the price of the asset going up or down in the unlisted space as well. Like this is much less volatile than the listed market, but of course that risk exists. And finally, on the taxation front, there's a slight difference versus listed, that in this you do have your LTCG gains that start two years after holding the security versus 1 year in listed. But honestly, the taxation piece is really, I think, a much smaller piece of the puzzle, because you're doing it for much different reasons. You're investing so that you can get much higher gains, holding a security that not everyone does, and getting then post IPO gains as well. So that I would say would be the least of the priorities, but the other risks are definitely something that you should you should know about and think about. Great. Now, how does the process work? So you identify which company you want to invest in, confirm the market price from a platform. There are, I think, a bunch of platforms that do it today, like us. But of course, there are limited ones that are good and are following certain norms and certain TATs and SOPs to ensure that you do get your securities in time. You transfer the consideration. So whatever the price is, let's say an example, you buy Oyo shares, it costs 60 rupees a share. You spend, you transfer 60,000 to the person who's selling it, in which case, whichever platform that is, and you receive the shares in your demat account within 24 to 48 hours. You verify the holdings in your demat, and eventually you just hold and wait until the company eventually goes IPO. Or if you do find an opportunity to sell before that, it's pretty seamless, where you can reach out to us again and we will try to arrange a buyer. And then at that point, you can also sell it in the unlisted market itself. So that way, those opportunities do exist. Create real world examples and opportunities. As we know, unlisted companies that went public. So this is just a bit of what has actually happened in the past. So these are some companies that were unlisted before they got listed. Not everyone takes the unlisted route, which is why we're calling out some companies. A lot of companies, after being a private limited company, just go straight to the public. They don't really operate in the gray market at all. Some do, and these are some of the companies that did see very, very good success. So Tata Technologies was one, Nazara Tech was another one, ICICI Lombard, and BSE, which is of course the Bombay Stock Exchange. Now, interesting opportunities that are emerging. Here are some of the interesting ones that we see that are there, that exist. I put my alma mater, Urban Company, in there because they are planning to go IPO, but I think soon enough, hopefully that might be available, might not be, we don't know yet, but these are some of the interesting opportunities that are there, which we are looking out for. NSE, OYO, NCDX, Sterlite Power, and Orbis are all opportunities that already exist, and there is liquidity in the market to buy and sell these securities. What I wanted to talk about here also is that, at times, and this is something we are doing a lot of effort on, is that we do try and get opportunities directly from merchant bankers, which are not in the public fray of listed securities, unlisted securities. And what that means is, let's say an AI company is launching, they are planning to go IPO in 6 months. They don't want to make a big noise and go into the typical public, but what they're trying to do is get into smaller cohorts of investors. So say they'll identify maybe 50 HNIs and try to be like, hey, we're doing this, and they'll do a small fundraise. And then those HNIs will perhaps, to make quicker gains, because they know they've got a good deal, they'll sell it at say 10% upside or whatever it is. And at that point, they become pretty good to invest in from a perspective of a retail investor as well, because at that point, it's giving you an opportunity which not a lot of people have. And like I talked about earlier in the presentation, that typically in investing, a lot of times the opportunities lies in knowing what others don't, or getting in on opportunities that others don't know about, because when the others do know about them, that's when the price starts really kind of rising, right? So you get in a bit earlier, and that's what gives you that edge. Finally, secrets and next steps. So this is something that I've put together based on what I have noticed in my experience, and also from a lot of live empirical evidence that I've seen over time. The ideal time to buy a pre-IPO share is typically 2 to 3 years before an IPO. Now, this is very hard because people are like, hey, I want to buy now and I want to sell now, and it'll be all good and I'll make a lot of money. But typically it doesn't work like that. You have to find the good opportunities 2 to 3 years before, hold them, and then wait for the others, like I said, to get to know, so that then the gold rush kind of starts, and your equity price goes up, which is typically how it works even on the listed side of things, right? Companies that delay IPOs. So at that point, if a company was going IPO, they are very serious about going, listing in the markets, but then they postponed their IPO or delayed it because they were like, hey, we're not happy with the valuations we're getting, or we see more upside. So that's a good opportunity to also enter that. Okay, they were trying, but we know that there's a clear path to IPO here. The third is look for opportunities to exit when the hype just goes into euphoria levels, right? So I would say MSCI was one of them that came on, which was specifically for some of you who do know, was the Metropolitan Stock Exchange of India. And, it was, the share price was at 2 rupees and went up to like 15 rupees in maybe like a month, or like 3 weeks. And at that point, when something like this is happening, you know that, okay, this is going into euphoric levels. So it's a good time to even exit in the unlisted market itself, because you know there are buyers on the other side, and that's what you would do even in the listed market, right? So nothing wrong with it, but you can easily that time liquidate that security. Finally, bet on sectors with high tailwind. So think about sectors that have the potential to do well because of, say, government push, regulatory changes, policy work, all of that. So that, you have to obviously be reading up things, and this another bulk of the work that we try to do here at Too Well, to be looking at the ecosystem at large and what's happening. So for example, we did a recent company in the AI space because AI is really upcoming, and lots of government pushes that are happening towards building large language models, etc. We're looking at companies in the broking infra space because we do believe that broking as a space will continue to grow and scale over the next 5 years. So those are just some examples. All right, finally, stick to the basics. Really, with everything that I've shared, and I've tried to scrunch a lot in the last 21 minutes, but stick to the basics. No need to reinvent the wheel. Buy good companies at good valuations and hold. So it's the same fundamentals of investing in listed stocks applies in unlisted stocks. It's just that it gives you access to I would say, a wider range of companies that perhaps you don't have access to in the listed space. Finally, also good time to invest in startups as they move focus towards profitable growth. So there was this time in the last 10 years when there was a lot of froth in startup valuation. So at that time, being a private investor in startups probably wasn't the smartest thing to do. But today, a lot of those valuations have tapered down. So case in point, in 2021, I think Oyo was at a valuation of 9.5 billion at its peak. Today, it's at about 4 billion after going down to almost 2.5 billion. So you can sense it. It almost kind of 1/4 from the highest point of its valuation, and now has stabilized at that 4 billion valuation mark. So this is and they're also now a profitable business. They weren't a profitable business then. So it's interesting to look at and track some of these spaces where you can see profitability emerging in spaces where they do have an advantage which others don't. So it could be scale, it could be distribution, it could be product, service, and so on. All right. Finally, we do have unlocking access to curated growth investments. That's what we do at TrueWealth.club. I'm just giving you, for those of you who don't know, I think some of you who are already here have either done a transaction with us before, or some of you who are still on the sidelines, waiting to build enough conviction. So this is to just tell you guys what we do, some of the work that we do here. We try to identify opportunities across these 4 spaces. And finally, we do have a personal finance coaching program as well, where we do work one-on-one with people to help them just become better investors if they're struggling with figuring how they should manage their portfolio, they should curate that. But the bulk of our products, which are transactional, or revolves around private placements, unlisted shares, mutual funds, and PMS and AIFs. But personally, for me, I'm focusing a lot on the unlisted share space also, because I do feel that it's one of the emerging opportunities that we have, which is also why you see me talking about it right now in this masterclass with you guys. How do we really what we deliver when we are trying to tell you all the products that we do is given we know there are, say, larger players or bigger players doing this. We typically try to do better than market pricing. So whatever they're offering you, we do a better job of pricing than that, simply because we don't have crazy top sort of bottom line costs. So we can give you that benefit as an investor with us. We have prompt support and delivery, no hidden charges in terms of what we already have, are showing you that that the charges are. There's no minimum investment value. We do select high quality opportunities. So we do a bulk of research work, which we share with our community as well. So for those of you who have been part of the community, you would see We run 2 series called TW Spotlight and TW Select, where we write one pages about different opportunities that are emerging in the market, so you can actually make informed decisions. And finally, access to real-time community to stay up to date. Cool. I think that's it. We're 25 minutes with 5 to 7 minutes left for Q&A. That was pretty cool. I managed to do this on time. So maybe I'll look in you can also, what I'm going to do is I'm going to allow people to also ask questions. Let me just open that. You can just unmute yourself, ask a question. It'll make me also feel like I'm talking to humans than just speaking to myself, which was what was happening for the most part. It'd also be interesting to know if you guys have been like, for those of you who have already invested in unlisted shares before, have you if you've invested in unlisted shares before, please write yes in the comments in the chat box. It'll help me understand how many people who are here have already invested before and how many of you have not. So that would be helpful. So if you have invested before, please write yes in the chat below, and that would be good to see. I can see 2 questions right now. Let me take those one by one while you tell me that. So you mentioned premiums based on supply demand in addition to the post-money valuation. The same can apply then for a discount as well. Yes, absolutely. So I think Aditya has asked that question. So essentially how it works is that just once the round has already happened, typically in a setup like a pre-IPO share, which is unlisted, nobody does a down round, because unless things are really bad, right? So a down round would only happen in a scenario where the company is really struggling and they've seen a massive drawdown in valuations in the market. But yeah, it does happen at times. So I think PharmEasy was one example where they were unlisted for a while and they saw premiums when they were doing really well, but then there was just sectorally the competitiveness, etc., was very high, and so they did see a down round. And a lot of the early investors and VCs also saw some valuation drops. So you're right, both apply. Mihir is like, pre-IPO, how do you know how much liquidity is there for the stock in case you want to exit pre-IPO? So typically when you're buying, whichever platform you're buying from, you can of course ask this question for that particular stock. But I would say you can also know by how many shares total. So there are some basic details like total shares available, like total shares issued by the company, and we'll know how many shares are in the market. So at that point we can help you understand, okay, that these many shares are there, and we can give you a sense of how many buyers, sellers exist. And that will give you a sense of if it's very liquid, not very liquid, low liquidity. But that's typically how you know as to how liquid a share is. I hope that answered that question. Please go ahead. You can unmute yourself if you want to ask a question.
Sure. Sorry, I just wanted to ask a follow-up over that. So
Sure.
in pre-IPO, you said that basically price does not change a lot in this thing. So if someone wants to exit pre-IPO, how do they make gains over there? So suppose like they bought at 150.
Yeah.
Then when would an opportunity come that the price of that security would be 175? How does that price change? Is there some kind of bidding process?
Yeah, no. So like I said, when I said there's low volatility, it means that it's not as dynamic as a listed security, which can essentially go up and down 30-40% in maybe a week. I mean, it can happen in the unlisted space as well. But on a day-to-day basis, for example, the morning price was 50, evening price is 70, rarely happens, which is very possible in a listed scenario. So that's what I meant with low volatility in terms of price. To your specific question, it can, of course, like in the unlisted market as well. So for example, we talked about Orbis. Orbis, I think when it had emerged, or let's say NSE, given more people in the group would know NSE, which is National Stock Exchange, when it emerged in the unlisted space, it was for about, I would say 1,500 to 2,000 per share when people started talking about it, actual retail plus investors, HNI investors. And then it went from 2,000 to about 10,000 now. And then split, and now it's at about 1,800 to 2,000 for the retail level. And if you want to buy high quantities, you'll probably get it at about 1,700. So typically that's how the price in the unlisted space itself works. So this is not This has not happened over a period of like a day or a month or 6 months. This journey that I just gave you an example of is probably a 5-year journey. So it, just like any other listed company, the price moves, but it moves over time. So you just have to be patient if you do believe in the theme long term. Well, awesome. Thank you so much for joining, and hopefully we'll do this again soon. So thanks, and we'll send the recording over as well. Thank you. Bye.